Here's a great example that again follows along an example that we talked about last week, except this is a case where a business owner who currently has 2 real estate properties, they gross over $20 million a year in annual revenue, so very good business. They've not only survived the downturn, but with the current economic environment, they've been able to continue to do very well. And so the entrepreneur who owns this business decided to make an offer on a 3rd property that is complementary to their existing business for many reasons. And not only did he make the offer, put the down payment in place, he waived conditions, but didn't arrange for his financing. And so there's a bit of some repetition here. If you've watched some of these Emily Now episodes, you'll realize that people waiving conditions or committing to real estate transactions without actually knowing how they're going to finance it is kind of a theme that is always hanging around because it happens all the time. Closing is a few weeks out, so he's come through mlenow.ca to ask for some help. We're going to use private financing to close on the transaction, and then once we've closed on the transaction, then we're going to take a few months and work with a traditional bank to refinance not only this property, but maybe some of the other 2 properties that this business owns as well. So the question is, why does this happen? Dylan, if you're telling us that this is a theme that we continue to talk about in some of these Emily Now episodes, why does this happen? Why do people commit to real estate transactions or any transaction without financing? And I think it's, in the case of an entrepreneur, part of their charm is that they'll look to act first and think later. But all jokes aside, many businesses simply don't know what's required to be approved. Imagine if you're an entrepreneur, you're running a business that grosses $20 million a year, maybe nets $2 to $3 million a year. You'd think life is pretty good. You maybe don't know where all of the dollars are, all of the dimes and nickels, but you know you're doing well. And so as you're operating your business each day, you see opportunities and you want to take advantage of them. And so you pull the trigger, you act first, and then you figure, the people that you have working for you, or the people in your center of influence, like your accounting firm or your bookkeepers or your advisors, that they'll just sort of figure out how to make it happen. But the cost of not being prepared, as I think many business owners simply they're just not prepared. I think it's hard to be prepared. I think it's hard to know where to get the information to be prepared. Of course, mlenow.ca is one of those places. But the cost of not being prepared is significant. So in this example, not only is the borrower going to pay probably maybe 3 to 4% in fees to get the financing, because he's borrowing it at the last possible moment he can borrow it, but he's also going to end up paying interest only in the double digits. So huge cost of capital, and then he's going to have to go through this whole exercise again once we go to the bank and we refinance these mortgages for him. So why would a business agree to do this? What's the rationale that a business has? Well, I can't speak to every business owner out there, but in this particular case, there's a few things. The property is being purchased, but it's being done so below market values. In fact, it turns out that this particular property is a court-ordered sale. So it's significantly below market value. It has to close quickly in order for the borrower to close on it and get that price. The property is adjacent to an existing property. It complements the business and will allow this business now to improve their operations because now they've got more floor space. It'll give them a whole new angle on how they can service their customers, which they didn't have before. And the property offers a few other leverage points for the business. So the real value in terms of what this particular property means to the business is far more than whatever the cost of financing is. Now that's not to say that with a little bit of planning that the business owner couldn't have been in a better position. Maybe if they had worked through mlenow.ca as an example, they would have known the income, they would have known the paperwork they would have had to put together, so when they made the offer, they probably would have had enough time to get it done at the bank. But because they're not really prepared, they don't have everything they need in order, they're going to have to use private financing, close on the purchase, and then after the purchase start working with a bank to take that money out. So if you find yourself in that position, much like this particular business owner, make sure you figure out or get your hands around what you think you're going to need to have in place in order to get financing. And it doesn't really matter whether you're buying out a shareholder, buying a competitor, refinancing your balance sheet, buying a commercial property. You need to be prepared. At mlenow.ca we have a score, and that score will help you in a very quick, easy way understand what you look like and what the banks that will fund you look like based on a score. And it's pretty simple. So that's one way to do it. Another way to do it, of course, is to visit with your accounting firm and make sure that you've talked to them and said, look, I think I might need to borrow some money in the coming year. What do I need to know? What do I need to have together? And what can you help me with? So make sure that you're prepared.